To introduce Dr. Eric Fry, Vice President, Finance and Strategy of GEVO Inc. The stock trades on the NASDAQ under the symbol GEVO. Eric, the floor is yours.
Thank you. Good to be with everyone today, and thanks to the Noble team for doing this conference. So I'm here to talk about GEVO. As you said, my name is Eric Fry, VP of Finance and Strategy at GEVO, and I'm in charge of investor relations. Check out our website. Our investor relations site has a couple of presentations as well as our 2Q earnings release for all the latest info on GEVO. But I'm going to talk today about who we are and what we do, and why last quarter was sort of the first set of full 3-month results that showed the impact of a transformative acquisition that we closed earlier this year at the end of January. Just a disclaimer, we'll be having some forward-looking statements in this presentation, as well as non-GAAP measures such as EBITDA. You can find non-GAAP reconciliations to EBITDA at the end of our presentation, which is this presentation, as well as in our 2Q earnings release. So GEVO is a renewable fuels company. We use renewable bio-based resources and fermentation to make molecules, fuels, and chemicals that are drop-in and cost competitive with fossil fuels. Think about diesel fuel for trucks and jet fuel for aviation, ethanol that's blended in gasoline for your cars, and methane, like the natural gas that comes out of your stove and powers a lot of industry. And we have a great team that's been doing bio-based fuels and chemicals for quite a while. In fact, we have a lot of years of experience, and we have cross-industry experience. So we have folks who are experienced in fermentation, chemicals, as well as renewable energy and biofuels. Folks in our team were the first to commercialize renewable plastics, polylactic acid, or PLA. You may see these biodegradable plastic cups that say PLA on the bottom. Members of our senior management team invented that back in the day, and so they've been doing this for quite a while. I'm going to flip to a slide that's actually in the appendix here. This is the same slide deck that's on our website. Historically, this is just to bring you up to today. So historically, GEVO was the first company to make hydrocarbon fuels from alcohols at lab scale. GEVO was the first company to get ASTM approval for jet fuel made through what's called the alcohol to jet pathway. So you take biomass, you put some of the starch from that biomass in a fermenter. Just like if you brew beer, you can brew beer in your garage, actually put sugar or starch from biomass in a fermenter with microbes. And they make two things, basically. They make alcohol and they make carbon dioxide bubbles. And GEVO was the first to make jet fuel through that pathway and get it ASTM certified. Also first to fly on a jet aircraft, a US Navy Warthog in 2014. And GEVO did this, we did this through a pilot facility in Minnesota that had 2 behind-the-meter wind turbines, as well as a facility in Texas that took the alcohol and made hydrocarbons out of it. So historically, GEVO has produced hydrocarbon fuels from alcohols, has made low-carbon alcohols and got them certified, and they've been flown on aircraft. We also have offtake contracts with many of the world's leading airlines to buy our jet fuel in the future when we make it at larger scale. Now, why do I say larger scale? Well, because what GEVO did after this picture that you're seeing here is we idled the pilot plant in Minnesota, and the next phase is to make it big and repeatable so that this could be a large, durable industry of making jet fuel that's cost competitive with fossil fuels, but from a bio-based resource. And so to do that, you need 2 things. You need the ingredients, the feedstock, the supply that goes into your manufacturing process, and you need a good business system, a good engineered mousetrap or plant design to take alcohols and make jet fuel out of it. The third thing that you need to do is rinse and repeat. You need to build lots of these types of plants. That's how the ethanol industry got big to begin with, and that's how we think the ethanol to jet industry will be big in the future. But right now we're in phase 2. So let me talk about that phase 2. And a big part of that was acquiring, doing the acquisition that we closed on earlier this year that I talked about. So let me go back to that. So where are we today? What GEVO has today is, like I said, we've produced jet fuel from alcohol in the past. Today, we're producing alcohols or ethanol. We're producing methane or renewable natural gas. We have a subsidiary called Verity, which is essentially a software startup within GEVO that we've stood up because we believe we'll need it for our own fuels. That is a track and trace software system to certify using DLT technology, the same technology behind things like Bitcoin, okay, distributed ledger technology, use an immutable token to prove that if you make a fuel, a commodity at the end of a value chain, uh, to prove exactly where it came from, because all the inputs in this complicated agriculture value chain matter to the carbon intensity and the sustainability attributes of that end fuel. The goal is to get the same fuel, like I said, the GEVO's goal is to get the same fuel at the end of the day, like jet fuel, like diesel, like octane, like methane. But it came from a process that didn't come from fossil fuels. It's complementary to fossil fuels, but it has sustainability attributes because of its inputs and where it came from. So that's Verity. And then this box down here that says GEVO Chem, we also do renewable, we do R&D as well. So first generation plants, we think we can make it cost competitive with fossil fuels, but we have to have a cycle of continuous improvement too. The common thread in all this stuff is that we're taking renewable carbon, so it's carbon that's pulled out of the atmosphere and grown at the surface of the earth to start with, instead of carbon that's been under the earth for millions of years. Make something that's scalable and that's cost competitive with fossil-based products while saving CO2 emissions along the way. So how do we do that? Well, I kind of briefly mentioned these four things that GEVO is doing today, but let me talk more about this one up in the upper left corner, GEVO Fuels. What is that? Let me flip to this slide. So earlier this year, we acquired an ethanol plant in North Dakota, and we're pretty thrilled about this acquisition. We closed at the end of January. It's 67 million gallons of low carbon ethanol and co-products. Co-products from corn ethanol include high protein animal feed and corn oil. But also, I mentioned earlier, when you do fermentation, you make bubbles, and those bubbles are carbon dioxide. It's actually a very high purity, 99% pure biogenic carbon dioxide. It came from the atmosphere originally, but Mother Nature does a lot of work in purifying that carbon dioxide and giving it back to us. Well, on this site, which is a 500-acre site, we capture that carbon dioxide off the fermenter, compress it, liquefy it, send it down a short pipeline on the property where it goes down a well that's actually over a mile underground into the rock. And it's rated to, in our view, be there permanently, but the engineers rated for over 1,000 years that carbon dioxide will stay there. So this is, people in the industry talk a lot about carbon capture and sequestration. There's a lot of promise to do that, and there's a lot of future plans to do it, but we're one of the few companies that's actually doing it. Every single day that we operate, we're sequestering about 165,000 metric tons per year right underneath this site. And we have capacity to do about 1 million tons per year. Like I said, it's a 500-acre site. And why is that important? Well, it's important for two reasons. It makes low carbon ethanol today, which is a profitable business in and of itself. But then it also gives us the platform to deploy what we think really differentiates GEVO, which is to take alcohols like ethanol and convert them to hydrocarbons like jet fuel. And so I'll talk a little bit more about that in a bit. In addition, we have a couple of other assets in our footprint too. I mentioned that we had a pilot plant. Here's the small demo plant in Silsbee, Texas, that we've worked with a partner in the past to make pilot scale volumes of these fuels. Here's the plant in North Dakota that I mentioned with ethanol and carbon capture. This is a 3D engineered drawing of our ethanol to jet designs. We have a couple. The two most important ones we call ATJ 60 and ATJ 30. Okay, basically a bigger one and a smaller one to make 60 million gallons and 30 million gallons of jet fuel from ethanol. We have a greenfield site in South Dakota where we want to deploy ATJ 60. There we have a conditional commitment from the Department of Energy for a $1.6 billion loan. And in North Dakota, like I said, we have 500 acres, and that's got an operating ethanol plant with carbon capture that we own. So we want to deploy ATJ 30 up there. In addition, in Iowa, we have 3 dairy farm partners who supply us with dairy manure from their cows. And we take that dairy manure, we run it through a digester, and we capture the fugitive methane emissions from that, clean it up, inject it into the local natural gas pipeline system, and sell that. And it's called renewable natural gas, or RNG. Again, it's the same molecule. Your stove doesn't know the difference. Methane is methane, it's CH4. But this, instead of coming from fossil fuels under the Earth's surface, it came from dairy cows at the Earth's surface. And so originally those cows obviously were ingesting carbon, and we captured those emissions instead of letting them go into the atmosphere. We have employees kind of all around, including actually some in India, because our view is that in the future, our synthetic aviation fuel platform, our vision of turning alcohols into jet fuel, will need people around the world and engineers to have a good mousetrap, essentially, that we want to deploy repeatably, because we think that we'll do this on our own sites like North Dakota, but then that will be a showcase to deploy it in many locations around the world. And that's how we get big. A lot of people ask us, well, how much SAF are you producing? We already produce SAF, or who wants to buy your SAF? We already sold SAF and it flew an aircraft. We already have offtake contracts with airlines. What we're trying to do is make it big. And so to make it big, we no longer need to produce SAF. We need to produce large amounts of the ingredients for SAF and have a repeatable engineered plant design that we can go, and that's how we get, that's how, in our view, how we get big and help the industry get large too. That's how the ethanol industry got large. And fermentation is a great way, it's a great alternative to fossil fuels. Fossil fuels are great. They are very energy dense. They're liquid. You can put it on a rail car and put it on a ship, put it anywhere in the world. You don't have to switch to electric aircraft to use fossil fuels. That's great. We want to make the same product that co-mingles with fossil fuels, but complement it by having a low carbon pathway that some markets will pay for. So that's what we have. Let me go into a little more detail on our carbon capture. This is a diagram of our asset up there. Like I said, it's 1 million tons per year in South Dakota, and it's great geology. You know, it's one of the thickest parts of this formation called the Broom Creek Formation. We have what's called the pore space rights to do 1 million tons per year. And like I said, currently we're actually sequestering about 16% of that as CO2 off our fermenters today. One of our goals is to increase how much CO2 we're putting down that hole. But carbon dioxide is a co-product for us. There's other things we could do with it, depending on what market wants it the most and will pay the most for it. By doing this, you can get 45Q tax credits, but also starting this year, you get 45Z tax credits if you lower the carbon footprint of your biofuel. And by doing this carbon capture, we're lowering the carbon footprint of our ethanol. You can also do enhanced oil recovery. So once you capture a lot of carbon dioxide from a really good source like this, you could put it on a rail car and send it somewhere else to do enhanced oil recovery. Or third parties could send us rail cars of CO2 and we can put it down our hole because it's a great place. We have a great sink for carbon dioxide. So we're extremely excited about this asset. One thing that we have to remind people about is when you do, this is true of the whole ethanol industry, and we're no different. The ethanol industry can start with any starchy plant or crop. In the US, the cheapest, most abundant source of plant sugar is corn. But the corn we use is not the kind of corn that is destined for people to be eating. It's not sweet corn or popcorn or white corn. It's field corn. It's corn that we mill. We extract the nutrients, the protein that ultimately goes back to animal feed and back into our bodies, the vegetable oil, and then the sugar. Now, we don't need more sugar, actually. The American Heart Association is telling us that we don't need more sugar. So in the US, we ferment sugar into ethanol, and you can make all kinds of things. You can make medical grade alcohol, you can make fuel grade alcohol for your car. And the US has done a great job of doing more with less. So on this chart over here, what you're seeing is a couple years ago, the US planted a little over 75 million acres for corn. 100 years ago, we planted about the same number of acres. it actually hasn't changed, that land use. What's changed is yield. Farmers are doing a really good job of being much more efficient, using less fertilizer to grow more corn from the same acres. And that goes hand in hand with sustainability. If you want to feed a growing planet, fuel a growing world, but also be kinder to the earth and reduce carbon footprint, this is exactly the type of industry you want to partner with, because doing more with less goes hand in hand with farmers having more money in their pocket. When you make corn, just so everyone's aware, by weight, the way to think about it is uh, if you get a pound of ethanol or jet fuel or diesel, you get about a pound of high protein animal feed, and you get about a pound of carbon dioxide. The carbon dioxide piece is easily missed. For us, we think of that as a co-product because the fermentation process is giving us, by weight, a third of what comes out of the facility is carbon dioxide that Mother Nature has sort of concentrated for us. It's a great source, but it ultimately came from the atmosphere because those seedlings, those plants, when they do photosynthesis, they're taking carbon dioxide out of the atmosphere to fix carbon and grow up. And then when we do this process, we get the bubbles that I mentioned. The bubbles ultimately came from the atmosphere. They're biogenic. So we're doing a form of direct air capture, if you like, but instead of using big machines and fans to do it, we're using Mother Nature. We're using photosynthesis and fermentation to do it. But the thing I want to emphasize here is that we feel like this is a way to maximize the efficiency of what we're good at. So if you're in farmland, which is good at making corn, in other parts of the world, it could be other crops, but in the US, it's corn. What are they good at making? They're good at making sugar or fuel for our engines. They're good at making nutrients for our bodies. And it's good at taking carbon dioxide out of the atmosphere. And if you've got carbon capture, you can put it down a hole where it'll stay essentially forever. This is a little more complicated view. So this is physically what's going on, but from a revenue perspective, when you go from corn to ethanol, there's all these co-product revenue streams along the way. So you're getting things called RINs, you're getting 45Z tax credits, and there are also state level incentives and credits. So if you go to California, Oregon, Washington, British Columbia, they have low carbon fuel standard programs. If you take that ethanol and extend it to jet fuel, you again get a bunch of streams of co-products. There's a SAF 45Z tax credit. We'll make some renewable diesel and some renewable naphtha along the way too. But also there are customers on the voluntary markets that will pay for the carbon abatement. So if we say we put a ton of carbon down our hole, someone in the world, like Microsoft or the NASDAQs or the Amazons of the world, they want to buy that certificate that promises that without double counting, they can retire that carbon offset against their sustainability footprint. And I'll talk more about that in a second. To do all this requires, you can't just know about agriculture, you can't just know about chemicals, you have to know about all of it. You have to be good at speaking farmer, so to speak. You have to have a good relationship with farmers, but you also have to have engineers that can innovate new to the world things. We don't have to invent new technology, okay? Taking corn to ethanol is not new technology. Taking ethanol to jet fuel, actually the steps to do that are not new technology. What you need to do is license the right technologies and engineer a good mousetrap to do it. And we think we're good at all those things. So all these co-products, all these revenue streams, they stack. You can get all of them, but there's one exception to that. If we have a choice each quarter where we point our gallons. We put it on a rail car and we send gallons of ethanol to end markets. And you could send them to places like Oregon and Washington, where they have low carbon fuel markets. That means that in that state, they have a cap and trade program basically for carbon. And if your fuel has a lower carbon intensity, it's going to get a premium for that fuel. And the premium is essentially 50 to 200 bucks per metric ton of carbon that we sequester. Okay, that's kind of the high level way to think about it. And those prices will vary each quarter because this is a market and they trade, okay, these carbon credits. So we like that. We send our gallons to these markets because we have carbon capture. But also at the same time, there's a new marketplace emerging, a voluntary marketplace of these carbon dioxide removals or CDRs. If you go to this website, cdr.fyi, it's a really good website. What you'll see is that there's actually been $10 billion of CDRs transacted, most of them over the last couple of years. And there are companies like Google and Microsoft that are doing this. And the reason they're doing this is they want to reduce their greenhouse gas footprint, and they're willing to go and pay folks like us that put carbon somewhere permanently, whether you're planting a tree or whether you're doing what we do, which is carbon capture. They're willing to pay you for it so that without double counting, they can retire that offset against their greenhouse gas footprint. And the prices there are more like $100 to $300 per metric ton. So this is a sales effort. If we sell our ethanol locally and maybe get less transportation cost, we can detach the carbon, the tons of carbon that we put down our well from the gallon of ethanol and say, hey, NASDAQ or Google or whomever, do you want to buy these tons of carbon? What's really interesting about this market is that only 2% of these CDRs have been delivered. We're very unique. We're delivering CDRs every day that we operate, because every single day that we produce ethanol, carbon dioxide is being produced off that fermenter and going down the hole. So we're developing this market, and we think we can get better pricing. But ultimately, each quarter, we'll send our gallons of ethanol to the market that gets us the highest netback. And we think we can do a lot better in optimizing how we do this. So this is a reason that we 8K'd our presentation a couple weeks ago. We said in 2Q that we exited 2Q with about $20 million run rate EBITDA. In fact, let me go to that slide actually. So this is what our 2Q results look like. And this is the first time that we had our acquisition, 3 months of our acquisition reported. And what we said here is that our revenue obviously has gone up because of our acquisition and some other activities, but also we exited 2Q at about $20 million per year EBITDA across our company, which is a big jump for us. And what we're saying here is that we think we can double that $20 million to about $40 million just by optimizing our commercial structure. Okay, it goes back to what I showed on that previous slide. Just by optimizing how we sell the carbon from our asset and how we maximize our clean fuel production tax credit, we think we can double that. And we think we can almost triple that again, get to this $110 million number, if we do minor debottlenecking and minor kind of expansions in North Dakota. Think of like a 10 or 15% type of expansion, as well as fully utilize our well, our million tons per year of pore space. So what's changed here is, before, like I said, GEVO has been a company about doing alcohol to jet. And now we're a company in this middle phase where we're profitable today with the ingredients to do alcohol to jet. What we're saying here is we can grow substantially even before we deploy a large amount of capital to build an alcohol to jet facility. Okay, just by optimizing the ingredients. We're still doing alcohol to jet, but now that baseline of where we are even before alcohol to jet has increased. We're well capitalized. We have 127 million of cash and restricted cash, and our debt is very manageable. We have 100 million of debt that's secured by the North Dakota asset that was used to finance the acquisition. So that's where we are. That's where we were and where we are, and how we're going to grow with where we are. But now what I want to talk about is, why do we like alcohol to jet so much and synthetic aviation fuel so much, and how is that the next leg of future growth for us? So jet fuel demand is increasing, but most other fossil fuel demand is on a decline. This is just EIA data over the next 10 years. The US will need 2.3 billion gallons per year more jet fuel, but at the same time, gasoline is not increasing. And that's because as population goes up, it's offset by urbanization and some electrification. And as people get more urbanized, they drive less, a little bit less, but also fuels go further per gallon. That's not true for aviation, though. People fly more as GDP goes up. Now, the US fossil fuel complex makes about 50% gasoline, but only 9% jet fuel. Okay, and that could be tweaked, but that's kind of the fundamental reality we're looking at. And the US hasn't built a new big refinery in a quarter century. The alcohol to jet process can make 90% jet fuel in its product stream. And so we think that alcohol to jet is a great way to supplement this new demand for jet fuel. What does it cost? So this blue scatter plot shows the price of crude oil in dollars per barrel on the x-axis, and then the price of jet fuel in dollars per gallon on the y-axis. And so as crude oil goes up, jet fuel goes up in price. We can make alcohol to jet in this green box here. It's cost competitive on a cash cost of production basis, and that's for plant number one. we think we can keep improving that for the second and third generation of plants. But for the first generation of large scale plants, we can kind of be competitive with fossil jet fuel. Other ways of making synthetic aviation fuel have higher operating cost. Power to liquids is kind of off the charts, not economic in our view, except in special situations. Now, what we need here, though, is the capital cost, the return. How do you justify building something? Because fossil fuels doesn't require building a lot more refineries, but alcohol to jet does require building new plants. For that, we have to capture value from it being low carbon. Remember, we're making the molecule, it's just as good of a molecule as jet fuel, but it's also low carbon. So to make a return on capital, that's where we need temporary, in our view, not permanent, but temporary tax credits or premiums from the customer, the NASDAQs and the Microsofts that I showed in that previous slide. But on a cash cost of production basis, we think it's pretty exciting that on day one, you can be competitive with fossil fuels. For each ATJ-30 plant that we build, like what we want to build in North Dakota, it adds about $150 million of EBITDA to the plant. That's by converting about 50 million gallons of ethanol to about 30 million gallons of jet fuel plus co-products. And the reason the margins are pretty good is just because it's again, it goes back to that low cost of production pathway. There's a target-rich environment to deploy these plants. So this is a map of 180 operating ethanol plants in the US. To fill that gap, that new jet fuel demand, you need to build about 70 of these alcohol to jet plants. Now, whether we build 70 and over what period of time is an open question, but if you go back to that previous slide, at 150 million of EBITDA per plant, you only need to build so many of those plants for it to be a new big industry and for it to be transformative for GEVO. And our goal is to have a repeatable mousetrap, a repeatable plant design. That's how this ethanol industry got big to begin with. We have a couple different plant designs, larger and smaller, that are sized to basically be bolt-ons or hub and spokes to take the ethanol from this existing industry and make jet fuel. We like it at our own plant in North Dakota. And what we would do is build more plants like that, but also license the engineered plant design. Not everybody in the ethanol industry should have to spend 2 years and over $200 million like we did to engineer the facility. Don't reinvent the wheel, just license it from us or let us take equity in your plant. And that's how this industry got big. In fact, many ethanol plants were being built per year over a several year period. And we think you kind of need another wave of that to make some jet fuel out of that ethanol. The Trump administration and the Biden administration before it, and many administrations before that, support agriculture and biofuels. So we get a lot of questions about, well, is the new administration going to not favor what GEVO is doing? Actually, they favor it a lot because we produce biofuels, ethanol, and aviation fuel, and that's exactly what they want to see more of. So what's our game plan? Our game plan is to leverage North Dakota as our sort of showcase site. Here's a 3D engineered drawing, like I said, of ethanol to jet. The goal is let's deploy to North Dakota. We'll use Verity to track everything. We'll use carbon capture, have our own ethanol, and that will become the showcase to do 1, 2, 3, and beyond, to do more of these plants to enable the blueprint for our growth.